Welcome to the Broken Pie Chart Podcast, episode 310. I'm your host, Derek Moore. No co-host today. Hopefully we'll get a co-host again shortly. Plenty of talk to talk about today. Got to talk about the tariffs, a little bit of market fragility, some option stuff and volatility, earnings, and some interesting new data about, analysts are actually pretty good. Got to talk about forward multiples and earnings estimates. We've talked about that before. And I had a question about somebody said, you always talk about the spread between 30-year mortgage rates and 10-year bond rates. Why is that? Why is there a spread? Why can't they just be the same? So, all right, let's start here. Let's start with earnings. And there was a piece in Yahoo Finance recently, or a graph. It looks like Sam Rowe was the source on this. And what he said is, and he didn't say this, believe it or not, I think a lot of people say, well, these are only estimates. And I always say that too. If I look at the forward 12-month estimate on the S&P earnings, it's $263 and 12 cents a share. And there's different ways to look at that. You could do a blended current plus 12 months. You could do just fiscal year. But looking at this, he said collectively, quote, analysts are surprisingly accurate at forecasting earnings. FactSet recently measured earnings per share EPS estimates for the S&P 500 companies at the beginning of the year versus what was actually reported for that year for the past 25 years. Excluding 2001, 2008, 2009, 2020, which were arguably outlier years, the average difference between the EPS estimate and the reported EPS was just 1.1%, end quote. And I'll put this chart in, I'll put a link to it actually. I think I can link to it, or maybe I'll just put the chart. But Sam Rowe writes a newsletter called Ticker, T-K-E-R. I don't know how he pronounces that. But anyway, I'm looking at this graph, and yeah, like they're pretty accurate. The years that don't work, like 2020, their start of year estimate was higher. In 2018, their start of year estimate was lower than they wound up being. But a lot of years they start out higher and then it comes in a little bit less. So I think the good news is, unless we get an outlier year, and again, who knows? This is why we hedge. Like not having to worry about this stuff if you have a hedge portfolio. But I look here, and the analysts expecting about 11.07% growth, about 13.5% growth, the year plus one. So like from months 1 to 12, it's like 11% growth. From months 13 to 24, it's 13.5% growth. And then they have, what is that? Month 36 through, month 25 through 36. There you go. If I could do math, about 9.7% growth. And I think, when you look at earnings, the further you go out, the less certainty, probably the less confidence analysts have. But this is sort of an interesting data point. And, analysts seem to be pretty good at this. What does this mean for markets? Well, the other part of this is we closed the other day about 22.96 times forward 12-month estimates. And so what does that really mean? What it means is that we're not low. We're certainly not low. We know markets over a shorter term, over a 1-year period. I think I've quoted that study before. The R squared is almost zero, meaning you really don't, just because forward PE is X doesn't mean that your return Y is necessarily going to be correlated. It's a downward sloping regression line for sure. But if I showed you the chart, and maybe I'll do that, I'll put that in when we publish it on ZigaInvestments.com. Usually I publish some of the slides along with the recording of the episode. But you'll see that over a 5-year period, there's more of a fit to the downward sloping left to right regression line. But really that's a good argument for hedging. So, but markets typically, and there's any number of reasons that go into it. I've always said I'm sort of fascinated by this. If I look at a chart of earnings estimates have been rising, so over the next 12 months and kind of a blended 12 months, earnings estimates have been rising, meaning analyst estimates have been going up. And part of it is the calendar moved forward. So as you get through one, let's say, quarter, and you move forward, well, now it's like, instead of being the next 4 quarters, January through December, now it's the next 4, April through next March. You kind of get where I'm going here. But when markets are trading on valuation, the estimates can come down and the PE can stay the same and the market would come down. The estimates could even be rising or stay the same, and the forward multiple can come down, which means markets have come down. You can have both going up. And that's what we've had really since the bottom of 2022. Earnings estimates on a forward 12-month basis continue to rise. And part of that is earnings have been rising, reported earnings as well. And then the multiple has also been increasing at that same time. If you go back to, 2020 is not a great example there. But okay. So earnings estimates came way down at the initial start of, I'm not going to say the C word. I don't know if they still put the disclaimer, the Joe Rogan treatment on your podcast, but the C word happens and earnings estimates go way down. And so the forward multiple goes way up. And then eventually the earnings estimates recovered and they started to go up as well. So it's one of those things where if we say, okay, well, if analysts are pretty good at reporting earnings, now it comes down to what we don't know is where's the market going to value those future earnings? And markets, we know, can pull back. Interest rates go up. In theory, if you're doing a discounted cash flow, you can value those earnings less. But I thought it was a good take and a good chart, so we spent a little bit of time on it. All right, tariffs. This is, and I'll be honest, I haven't dug in like I normally would. It just into really the details of tariffs on what, retaliatory tariffs on what, and these types of things. I'm going to give you a different analysis on this. And so took a look, and according to, who is this? Census Bureau and TD Economics, there's a graph. And it was basically share of 2024 total U.S. trade deficit. It says deficit, but I believe they mean trade deficit. And if you look at, let's see, so Mexico, China, and Canada are the companies. There's sort of some implication on for NHL hockey. All right, I'll come back to that. And it deals with currency, but let me come back to that because many of you may not care about this. We have listeners all over the world. But if I look at China in 2024, 30% of the U.S. trade deficit, so not necessarily U.S. trade, but trade deficit, was from China. Mexico was, I'll call it, I'm eyeballing it, about 22%. And then you have Canada was less than 5%. So, and then the other thing that they had here, let's see what this is all about. U.S. and Canadian auto production, number of light vehicles produced versus consumed. So I think the point here is they're trying to show that Canada consumes a lot of U.S. vehicles. They don't necessarily produce a lot. And the U.S. consumes a lot more. I mean, if you look at this, they consume more than 2 times the amount of vehicles that are produced in the U.S. So, I mean, that's one way of looking at it. Tariffs are interesting because, and one of our listeners was nice enough to send me an email. I say stuff all the time, and sometimes listeners are like, hey, did you ever think about this? And it's great. You can send me those emails at derek.moore@zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly.com. If you can't spell that word, you can't get an email to me. But the idea of, what I'm interested in is how selective some of these tariffs are. And if it's something so I'll give you an example. Let's say the U.S. doesn't make ABC widgets. I don't know what those widgets would do, but let's say they don't make them. And they can only get them from another country. And that country throws 100% tariff on it. Well, if you can only get it from that other country, and that other country alone, and you can't make it yourself, you can't go to other countries and get it, well, you just, your costs go up, and either you're, if that's something that's absolutely needed and the demand is going to stay constant, all right, well, that's going to double your price right there. So you start to see this gets a little bit intricate of where are their substitutes. The other thing that nobody really talks about yet is I wonder if there's going to be a move to do fiscal stimulus and to try and, similar to what they're doing with the semiconductors. So in Arizona, where I live, TSM is building, Taiwan Semi is building a huge facility in Arizona, just northwest of Phoenix. And I believe they got U.S. government fiscal stimulus as part of that. And who knows, what else, where they get tax breaks or Arizona tax breaks, although our taxes are not very high here. So that's another thing. But obviously the counter argument to that would be, what if it takes a long time to get that domestic supply up and running? And can you even do it? So I think the thesis on the markets, or by the markets, was that these were a negotiating tactic, and who knows if they'll actually go in. Then the second thesis is, even if they go in, then they'll only be there for a short time because they're a negotiating tactic. And we saw the market dipped on, it was probably a week ago or so when the talk of the tariffs first came up, but then quickly recovered the next day. Towards the end of the trading session on Friday, so I'm recording this over the weekend, over Friday, the market was up, I think, I'm trying to remember if it was up 0.5% or close thereof. I'm just thinking of the chart in my mind, not the percentages. And then it winds up turning and then closing down about 30 points, which is about 0.5%, based upon a little bit over 0.5%. So, these things still have to bear themselves out. But I said I was going to give you a different take, and I hinted at it, and it's currency. And so one of the things that's happened is the Canadian dollar has gotten weaker relative to the US dollar. Now, if you haven't traded currencies or just looked at currencies before, you've probably traveled and you go up and they say, here's the exchange rate. It's 10-1 or 5-1 or whatever it is. But when you're looking at a currency quote, they're in pairs. So for example, if you're looking at the Canadian dollar, that should be CNH, right? And USD is the first one. So there's a way to read these, and I'm just punching in, pulling up a chart on it here. Yeah. So CNH is the China one. I'll get to give me a second here. I'm almost, see that? I almost messed that up because I'm trying to talk and pull up charts at the same time. CAD is the Canadian dollar. So let's go back to let's start with the Canadian dollar first. So when you have a currency pair, USD, CAD, what that means is the one that's second. So right now the quote is 1.4722. USD, CAD. It means the second one, that quote that you see is how many of the second one do you need to get one of the first one? And if you reverse it, which sometimes they do with CAD/USD, it would be how many USD to get one of the CAD. All right. I'll save you a whole couple hours reading in a textbook, but that's how they're priced. And if you could see the chart, and I may put this into the show notes as well when we post it on ZegaInvestments.com. The dollar, the Canadian dollar versus the US dollar went from 1.44 to 1.4724. And it's, is that a big move? I mean, it's on the chart. It's definitely a move. So the reason why I bring up currencies is because there's a relativeness about purchasing power from one country to another. And from the low in September to the current price right now, US dollar / CAD, Canadian dollar, is, it's the currency for Canadian dollars has gone down almost 10%. And the reason why I bring this up is because it's one of the inputs or one of the factors. So imagine if there was just a 10% tariff. There's not. I believe they've announced 25% tariffs. But if that currency depreciates by, let's say, 25%, in theory, they could raise their prices 25%. And somebody in the U.S., a U.S. company purchasing things from Canadian companies or sources, that currency move is sort of mutes the tariff. So it's one way of looking at it. If we look at the Chinese renminbi or yuan, this one USD / CNH. This one, if you go back to 2014. In 2014, it was 6.03 to 1. And today it's 7.3592 to 1. And so that has appreciated 21.9% since 2014. I know it's not fair to go all the way back to 2014, the beginning of 2014. It's a long time ago. So then I looked at 2022, and this is February 28th, 2022. And the Chinese currency has declined 16.5% versus the US dollar. The other thing that's interesting about the China right now is their interest rates are collapsing. So they're doing stimulus. They're sort of, they're easing in interest rates, and they're doing any number of ways of how they're doing that. But 10-year yield there is 1.63%. I think 1-year yields, I'll try and pull this up on the fly as I'm talking here, or maybe 2-year yields here. 1-year yield, if I can find it. Sometimes I got to do this quickly, but I believe it could be under 1 now. I'd have to double check that, but you get the point. Like our yield is above 4.5. So financing costs are less, and their currency is. So that's one of the things a country like China could actually devalue their currency more to blunt the effect on that, because that would mean that U.S. companies would still be able to buy things or have things made in China and pay, doing the exchange from U.S. dollars to Chinese dollars. So it's just another way of looking at it. What does this mean for the markets? Markets don't necessarily like uncertainty, and there's this concept of fragility in markets. So fragility in markets is a term that really, if I'll look for a definition here, but it's basically that it's on edge. It is fragile, and news or events or, different things that happen could cause an air pocket in markets. And I think it's just, you saw some of that fragility on display on Friday, because those tariffs were announced. They were announced, and then I think President Trump came out on Friday and said, yeah, we're going to do it, start Saturday. I think they had already announced that. But that seemed to, the new reiteration of those seemed to cause the market to reverse course. And it was, as I said, I think it was up around close to 0.5% at one point, and then came down, ended down around 0.5% down. So kind of a 100 basis point swing there. So, but this idea of fragility is, that little things like a fragility correction. I think somebody once coined it. I don't remember who did that, but it's this idea. I mean, this is one of the reasons, the arguments to, if you're a long-term investor and we run strategies that hedge or buffer, having something like that makes a lot of sense, since you don't, it takes some of the decision making of, oh, if things are fragile right now, I want to get out. I will tell you that, and for those of you who listen, I never really get into performance data. I never get into those things because there's a whole other threshold of disclaimers, and there's different rules around things like that. You can go to our website, zegainvestments.com, and see all our strategies and things like that. But we run a quant strategy, and it's a volatility analytical strategy. It's got 21 different volatility-based triggers, and just any number of things that go into it. And I will tell you that a couple days, let me think when this was. Was that Monday or Tuesday? I'm trying to remember now. But we got a signal that was bearish, and there's really two ways that we do it. It's a bullish or bearish signal, but it's also, do we expect there to be a wide range in price or a smaller range in price? And there's these inputs. And yeah, I mean, that one gave us a bearish trigger. Does that mean that you should get out of everything? No, that's not what I'm saying. Don't do that. In fact, people we manage money for, they'll have different pieces of different strategies that do different things at different times. So, but we started to sort of see the volatility markets give us some indication about maybe there was going to be some weakness. What happens going forward? I mean, we don't know. We don't know. That's why we hedge. But I think we could be in for a little bit of fragility while things get digested. The big concern that people have is this will be inflationary. And I guess is it good in the short term or the long term, or is it bad in the short term and good in the long term? Is there some sort of analysis on this? And in theory, if you get reshoring and you get manufacturing, being built here, that helps the U.S. GDP, and you'll have CapEx spending and different things like that. But remains to be seen. And options markets, if we look at something like, the VIX index, which of course is a 30-day forward view of volatility. It's not traded, and it looks at the bid ask on the S&P 500 options chain. I think volatility is not crazy. It's not really crazy high. In fact, we saw volatility. I mean, it didn't close above 20, but on the 10th, we saw it close 1954. Intraday, it went up over 20. It's 1643 right now. So the markets are not necessarily, there's not an exorbitant amount of fear right now, but I would say that there's a little bit of fragility in those. And it may not be, I'm not saying that the market will go down and will go up. I'm just saying that there's some things there. The other news that happened is the DeepSeek stuff. And I'm not going to spend too much time on this. I mean, you can find other podcasts where they go really deep in it. But in my opinion, and I saw Professor Aswath Damodaran put out a piece on this, and he really crystallized it on what that news meant. And really it is, hey, let's just look at the semiconductors. If this model, or if what they've done is correct, and they're able to produce these results with much, much less equipment. I'm just going to dumb this down for a second. Then maybe the CapEx spending doesn't have to be as much. And that's why when the VIX shot up to over 20 intraday, it was kind of a rethinking of, do we have our assumptions on earnings, on CapEx spending, on revenues? Do we have that right? And so whenever there's a shift in the markets, or what people think is the common narrative or the common agreement on what's level setting the market, whenever there's a change in that, you can have this abrupt adjustment. So, we'll watch that thing. And I still say that we had Spencer Wright on, remember, a couple of weeks ago, and I asked him, do you think AI is the next great technical revolution on par with the internet, on par with, electricity and steamships? And he had said, yeah, maybe, right? So the story with AI really goes back to productivity and increasing margins. And we've seen the margins continue to be higher, especially in the large cap US tech, where their margins have expanded. So something to keep an eye on. All right. I had a listener question, and they said, the question was, Derek, you keep mentioning that the spread between 10-year mortgage, 30-year mortgage rates, and 30-year mortgage rates are of interest to a lot of our audience, because if you're looking at buying a house or looking at selling your house and buying another house, then, imagine going from a 3.5% or a 3% or 2.875 mortgage to a 7% mortgage. It kind of, it locks you in a little bit. But the question was, you've said that historically there's 170 basis point difference between the 10-year Treasury yield in the US and the 30-year mortgage rate. And that's right. And I remember I pulled down the data and I just did an average, and I forget how many years I went back, but I did that. The US 10-year Treasury yield right now is 4.5387, so 4.54 rounded. And 30-year mortgages, let me see, this might be a bank rate index. I'm getting this off Bloomberg, 6.96%. So it's a little bit under, if we round it 7% minus 4.5, that's 250 basis points. And so, by the way, when I say 250 basis points, people ask me sometimes, what the heck is basis point? There's 2.5% difference between those two, meaning if it's 7 minus 4.5, that's 2.5. But people talk in the industry in basis points or bips. So you say, well, it's 250 bips difference. And so a basis point, imagine if the 10-year yield was 4.50 and it increased by 1 basis point, it would go from 450 to 451. Okay. All right. That's the lesson for today. So why is there that spread, and why is it widened? Well, if it's normally about 1.7%, you would say, well, okay, if I took 170 bips or basis points and I added it to 4.5, I'd say if I use the historical average, mortgage rates should be about 6.2% right now. And just because it's the average doesn't mean it will be going forward or anything like that. But I think there's a couple things. One is, you have to understand, when people buy a mortgage bond, why do they demand a higher rate of interest than the US Treasury? Well, for one, you have different type of credit risk. And that's something. If you buy a Treasury, essentially you don't know. Depending upon the duration, you have interest rate risk, but you really don't have credit risk. You may have purchasing power risk with the currency and all this stuff, right? But you really don't have, the 3-month Treasury is considered the risk-free rate, because you put your money in it for 3 months. In 3 months, you get your principal back and you get an annualized amount of interest. And then you do it again. So you don't really have reinvestment risk. So, but if somebody buys a mortgage bond or a collection of mortgage bond, collateralized debt obligation, or a bond that contains thousands of mortgages. So what is it why do you demand a higher rate of return? Well, look at it from this way. Imagine you were buying a house and you said, I'm going to buy a $1 million house, and I'm going to put up $200,000, and you're going to loan me $800,000. And you're going to loan me $800,000 at 7%. We'll do it right now. Well, let's say mortgage rates went down to 4%. And you would probably refinance, before then. But let's say they suddenly dropped to 4%. Well, as a mortgage bond investor, I mean, imagine I just created one bond with one mortgage in it, and essentially that's what I'm buying. You're going to refinance. And what that means is if interest rates went down, that much, and right now it's 250 bips difference, so the spread's a little wider. More on that in a second. But you're refinancing. And what that means is I'm going to get my principal back. Great, good for me. I get my $1,000 per bond back. You pay off your mortgage, and then you refinance into a new one. But I have that capital now. I have my $800,000, and now I have to redeploy that in another instrument. And I have what's called reinvestment risk. Because when I go to reinvest that, let's say if I want to find another mortgage bond at 7%, that's no longer available. So I've got to maybe, if rates went from 7 to 4, well, now I get to reinvest my money. But instead of having 7% a year for the next 30 years, in theory, well, now I go into a new mortgage bond and I'm only getting 4%. So it's called reinvestment risk. And it's this idea that there's convexity. Convexity is the sensitivity to interest rates and different things like that. Mortgage bonds act differently. So that's why there has to be sort of a spread, because one, there's credit risk involved, but also it works differently in that if rates go down, the value of that doesn't necessarily go up like a regular treasury would or a corporate bond, because somebody's just going to refinance that, or they're asleep at the wheel and they don't. And those would be nice to have. So that's why. I think part of the reason why, and I could be wrong on this, email me if you think you have another opinion. But if I look at this and I say, the prevailing narrative was that the Fed was going to be very aggressive in cutting rates. And so if you are an investor into mortgage bonds, and although you have a 7% yield or coupon right now, if the prevailing thought was, hey, the Fed's going to slashing rates and people are going to refinance, you're going to say, great, I have the 7% bond, but then in a year, I'm going to get refinanced out of it and I'll get my principal back. And then if I go to a new bond. So I think the demand right now, or has been, we'll see what happens going forward, but I think the demand was for a higher coupon and more of a spread against the 10-year yield. And there's a link between the 10-year yield, treasury yield and mortgage bonds. So if you are someone who is kind of watching and saying, I'm hoping to buy a house. And I'm the last, we're not real estate investors. We're not experts on real estate. There are other people you can go to on that. But if you're saying, well, I'm waiting for rates to go down, really, you're making a call on the 10-year treasury, and you're making a call on what the spread is going to be between the 10-year treasury and a mortgage. And so it's actually a little bit more of a complicated, if you're sort of making a bet or a trade as someone who's saying, all else equal, and it never quite is, do I think rates are going to go down? The good thing about a mortgage is it's a put option. And we think about, normally bonds, some corporate bonds come out and there's a call option in there. And the call option it's a callable bond. So let's say a corporation issues a bond at 7% and then rates drop, but they have a call provision in there. Well, they can call it back at par, or maybe call par plus a premium, and then go and refinance into a new bond at lower. People have mortgages in the U.S., and by and large, I don't think there's prepayment penalties. But if you have a mortgage and mortgage rates really, really drop, you have the opportunity potentially to refinance. So you have sort of you have a call option. I guess not really a put option. Put would be, you put the investor could put demand the capital from it. So really, you have, it's like a callable bond. So you have the ability to refinance it. You can say, no, I'll take the principal that I owe on the loan. I'm going to pay that off early, and I'm going to, call that loan back in, and I'm going to actually go out and refinance. So that's why I went a little long there, but I feel like sometimes experts throw around different terms and they throw around numbers, but they don't really explain it. So hopefully that makes sense. It's about reinvestment risk. And I'll save the the convexity oddities of mortgage-backed securities for another time. Convexity is on par with gamma when it comes to options. Final thing I'll talk about is earnings. Another big week. Well, yeah, it's still, the really, really massive earnings. We still have NVIDIA, which is always late. Of course, Nike is like the very last one that I can think of. But what do you have this week? Well, you have AMD. Oh, no, it is a pretty big week. Okay, I lied. Pfizer, AMD, Alphabet, Chipotle, Uber. Who else is in here? Qualcomm. There's Amazon in there. Eli Lilly. Yeah, there's some stuff going on here. So who should we look at? Well, first, let's look at Amazon. Amazon's options expiring on February 7th. So that is, that's Friday, and then earnings are Thursday after the close. So if we look right now at the implied volatility of the options, it's about 67%. So, that there's still some time because there's still some time left. So that probably might go up, it might go down before, I shouldn't say that. But if it's 67 right before earnings, basically that's implying about a 4.2% 1 day, one standard deviation expected move. The other one, let's see, Palantir. Palantir's after the close on Monday. Let's look at Google's the other one we can take a look at. So I'll look at Google, and I want to look at, so they're on Tuesday after the close. They closed around 205.60. So let's look at the 205s. Their implied volatility is about 62.90. So, there you go. That's, it's not crazy. It's not, let's look at Palantir. Palantir, I'm curious on them. So Palantir closed at 82.50. Let's see. Yeah, here we go. 139% at the 82 call. So let's dig into that a little bit. So these are Monday after the close. So, this is the thing. If you are an investor and you buy these or sell these, you're going to have these expire next Friday. Monday after the close, you have an earnings announcement. After earnings, the volatility is going to get sucked out of those, but then you have no idea where the stock is going to go up or down. At 139% implied volatility, basically what that's computing is to about an 8.76% one standard deviation move. And to give you an idea on this, it's right between the it's right between the two. Let's use the 82. So if we used 82, it's a half, 50 cents in the money. It'll be 50 cents out of the money for the put. But if we bought the 82 call, and I'm not saying to do this, okay? Don't do this at home. That's about $6.10, or at least it was. Who knows where it's going to open. And 543, so what's that? 11.53. So 11.53, and that's the price of the quasi straddle. If I wasn't doing this live, I would do it as a strangle. Meaning, probably buy the 82 put, buy the 83 call. That's a strangle rather than a straddle. But basically, if the stock, if you own that, it has to move 14% for you to break even. So this is why I always say, I warn people, the straddle sounds like it's, really easy because you're like, oh, of course it's going to move. Of course I know it's going to move. And that's the thing. Who knows? The strangle, by the way, so if you buy the 83 call, that's $5.50, and the 82 put is, that's about, call it 5.5 too. So that's 11. And, you're 50 cents out of the money. So basically it's 1150 it has to move. And let's see if this is any different here. I'm doing this live, divided by 82.49. Yeah, 14%. So same thing. So yeah, like you buy that, and if you think it's going to move more than that, all right, good for you. If you sell it and it moves more than that, bad for you. And so it's just these volatility trades are very, very difficult. But what this is telling you is, to kind of round out the discussion, that the options market is expecting Palantir to have a higher move than Alphabet. And we looked at Amazon too. So the options market knows that there's some volatility expected, and it tries to, basically the way options are priced, it tries to price in what the expected move is. And you can be buying that, you can be selling the volatility, buying the volatility, and I'll let you know Tuesday morning for Palantir which one was the right call. So, all right, that's it for this week. We'll be back next week. Send me emails. I like getting emails, and I think I mentioned before, Jay and I are gonna be co-writing a book, and some people have sent us some topics they want us to cover. So send me email, derek.moore@zegainvestments.com, and we're sort of soliciting feedback from that. But that's a project that we're excited about, and people have asked us, "Hey, why don't you guys write a book together?" Yeah, we're doing it. We're gonna write one together. We've written ones independently, so. And we'll have some option stuff in there, some stories in there, some different topics. So, but feel free to email me and share this episode with a friend or someone who's not a friend. Thanks. See you next week. Oh, by the way, before I forgot to do the recommendations. So I finished watching The Agency, and it grew on me. I actually liked it. I found out it's coming back for season 2. It's on Showtime. So all the episodes are out now, so you can actually plow through it. I stuck with it. And I think it was actually pretty good. I think it was pretty well done, and there was some suspense in it. And yeah, well, I think they set it up nicely for season 2, because I was thinking, if this is going to be it, they really haven't developed some of these storylines, but for sure. So I think I'll give it a recommendation then. I'll give it a buy recommendation. It's on my conviction list. I don't know about that, but I give it a buy recommendation. So there you go. All right. So that's it. We'll be back next week. See everyone. Send me emails. Take care. Bye.